Hello and welcome. I'm Judy Moses, partner and portfolio manager at Evercore Wealth Management. I am joined by my colleague, wealth and fiduciary advisor, Neja Galatano. Today we want to spend a few minutes discussing one of the biggest changes anyone can go through, divorce. Nearly half of marriages in the U.S. end in divorce. Interestingly, it's divorce rates among adults age 50 and older that have been on the rise. And no matter how amicable the situation, the one thing divorces have in common is that there are periods of great change and reassessment. If you find yourself in this situation, you're not alone. At Evercore, we help clients through the divorce process to make informed decisions, and not only through divorce, but other major life changes. In these emotional transitions, smart and proactive planning can make a big difference. Neja, you're a certified financial planner, but also hold the CDFA, or Certified Divorce Financial Analyst designation. Can you tell us why you decided to pursue those additional credentials?
Absolutely. Early on in my career, I quickly realized that there was an unmet need for strategic financial planning advice, specifically through the divorce process. Oftentimes, clients come to us once the asset split has already been decided, and we're facilitating that. But the feedback I continuously got was I didn't have, good financial planning advice while we were deciding how to split the assets, or I didn't have anybody to guide me through the aftermath and of redefining what my financial picture looks like now. So I really wanted to learn about the specific components and critical issues that are relevant to divorce planning before the divorce is actually completed.
And I think many of us know people either going through divorces or having been divorced, so I appreciate that having a knowledgeable person to guide an individual through that would be helpful. So what would be the very first step that you would recommend?
Before we're even talking about divorce, we should be talking about prenuptial and postnuptial agreements. These can be very difficult conversations to have, but that agreement is a crucial planning document that I recommend to any one of my clients or their adult children who are entering a marriage with assets. Beyond that, and assuming that reconciliation has already been exhausted, the divorce is going forward, the first step would be to engage a divorce attorney who should be different than who you've worked with in the past or who your spouse is working with. That attorney is going to help guide an initial conversation to identify the implications of the state that you live in, review those pre- or post-nuptial agreements if they exist, and get a rough sense of your financial picture. From there, they can guide how much really there is to be negotiated, what your rights are, and also what type of divorce is appropriate. There are typically three types of divorce processes: mediation, collaborative divorce, or litigation.
My understanding, though, is actually litigation divorces are not the norm, and a very small percentage, which I'm sure people listening would be happy to hear. So collaborative divorce, or otherwise known as traditional divorce, is when each party has an attorney representing them, and the negotiation really takes place between the attorneys. Is that right?
That's right.
So then what would be the next step after that, after engaging the attorney?
So the next step would be to build out a team. Depending on your specific situation, your team might compose of any number of professionals, but typically a team will have a CPA, a wealth advisor, and that divorce attorney. The wealth advisor is going to be the person who is coordinating all the other specialists. They're going to be coordinating the discovery process where you're aggregating all of your financial information and doing a deep dive and building out your balance sheet and your income and expense summary. For those who are not as familiar with their financial picture, a great place for the CPA and wealth advisor to start is your tax return.
I agree. I think a tax return contains a lot of information. It'll give you an idea of your joint income, investment accounts, maybe any business entities or private investments. But there are a lot of things that don't actually land on the tax document. So could you maybe go over a few of those?
Absolutely. What you won't find on your tax return will be things like retirement accounts, unvested company benefits, non-rental real estate, direct private investments that don't produce K-1s, just to name a few. The bottom line is the most crucial starting point of the divorce process is to get a full financial picture, become aware of what all your different components of the balance sheet are so that you can then start to ask the questions of what it is you want to negotiate for.
At Evercore, we work with clients updating their balance sheet frequently as part of the financial planning and investment process. How would putting together a balance sheet inform decision-making during a divorce?
The balance sheet is the first step of any financial decision. Divorce is no different. So within divorce, we really look at the balance sheet in the context of what it is the client would like the outcome of the divorce to be, and we analyze the assets and make recommendations in order to achieve those goals. I think for everyone going through a divorce, the key analysis that we do that people need to realize is that equal does not mean equitable. What I mean by that is two assets with the same market value are going to have different liquidity, cash flow, and tax components that are going to make their inherent value potentially differ significantly. An example of that is a $1 million brokerage account that is fully liquid and that is taxed at capital gains rates is going to have a different inherent value than a $1 million IRA, for example, which is not accessible until age 59 and a half and is thereafter taxed at ordinary income tax rates. Another big sticking point that often comes up in divorce is who's going to get the house. Whether for emotional or practical reasons, a lot of clients want to retain the primary residence as part of the divorce.
We've seen that with clients, particularly when there are children involved, either children at home or even still children in college. And even though there's an emotional attachment to the house, what are some of the financial issues that one should consider regarding keeping it?
So I look at the primary residence, which is illiquid and not only doesn't generate income, but typically has significant carrying costs associated with it. And I look at that as a proportion of the overall balance sheet. If there isn't ample liquid investments or alimony or income to cover the carrying costs at home, it can potentially cause issues down the road and, in a worst case scenario, a forced sale. You also need to consider if there's debt associated with the home and what the servicing costs of that debt are. Another factor to consider for everyone going through the divorce is, as of right now, we have a exemption on the sale of a primary residence to the tune of $500,000 of a capital gains exemption. Post-divorce, the individual retaining the home loses out on their spouse's half of that exemption. So you could potentially also be increasing the embedded tax associated with the primary residence post-divorce.
I also think we should mention potentially assets on the balance sheet that have very little present value but could have significant future value. And I'm thinking private equity, venture capital, real estate, or a business interest. And oftentimes that will require an individual to engage a special valuation expert to actually give a dollar value on those assets as well.
Absolutely.
So once we've built the balance sheet, what is the other financial information that you'd be gathering for a client?
Sure. The other very important component is the income and expense statement. So figuring out what kind of lifestyle an individual is accustomed to, what their income replacement needs are going to be if they're not earning income post-divorce, as well as looking at the expenses and how they might change post-divorce. As part of this, we also need to take into consideration future expenses. The largest of that is going to likely be education if you have children. Who's going to pay for secondary school and college? That decision, even if it might be years down the road, needs to be made now as part of the divorce process.
So just from our brief discussion, it's clear that there are a lot of facets and considerations regarding divorce. So let's assume that we're through the process and the divorce is settled. What are the next things to consider?
So it's going to take a while for any client to figure out what the new normal looks like. I have clients who completely overspend and upend their finances in the first year or two, and other clients who don't want to make any decisions or changes. The bottom line is this is a complete overhaul of any individual's financial picture, and it's going to take a while to reevaluate and reassess what's needed going forward. So we start once again with that balance sheet and the income and expense summary, now focused on the individual rather than the couple. And from there, we build out a long-term plan. We start with a lifestyle analysis, and that's going to inform what kind of income needs to be generated and pulled from the portfolio, what the tax implications are for the individual, as well as plan for any longer-term expenses that we should plan in advance for. All of those things are going to lead into the discussion around portfolio construction, and that's really where you and I work closely together.
So in the case of divorce, it's often the income requirement that drives a lot of the investment decision-making process. If we know that we have a known income need for the next year or two, we'll generally keep short-term liquid investments available for that, but also with an eye towards longer-term growth of the portfolio to meet the client's lifestyle needs and to maintain their lifestyle.
Right. And a big portion or a big component that we need to consider as part of that is taxes. Whether you're the individual that is continuing to earn after a divorce, or you are not working and you no longer have income, any people going through divorce are going to have a different tax profile after the transition than before.
And actually, here again, the tax bracket may affect some of the choices with regard to underlying investment vehicles. Are we going to be investing in municipal bonds or taxable bonds? Those have different characteristics. Another issue that should be revisited is the client's risk tolerance. So as a single person, their risk tolerance may be very different from what it was as a couple. We want to make sure that the portfolio, in addition to meeting any income needs, also generates long-term growth to make sure that the client can maintain their lifestyle. So that's an important component too. And it's not a set it and forget it or one-size-fits-all solution. An asset allocation should be revisited over time, particularly because an individual's circumstances will change.
Absolutely. And that's why we call it a financial planning process, because it's continuous and we revisit it often. And I think that's also the beauty of us being able to work together as a team for our clients and always having 2 senior professionals for every client relationship. It really allows us to make thoughtful and strategic plans for our clients.
As you can see from our discussion today, divorce is not easy, even under the most amicable of conditions. However, having an experienced and engaged team helping you along the way can make it much more manageable. Neja, thank you for your time on the topic today. We also have written an article for our 50th edition of Independent Thinking to accompany this video. If you'd like to learn more about our capabilities and how we may help you through life changes and transitions, please visit evercorewealthandtrust.com or feel free to contact us directly. We look forward to speaking with you.